Okay, everyone, welcome to MacroAce with your host Tony, also the head financial analyst at FinancialJuice as well. Let's go through the ECB rate prep. We've got quite a bit to go through, so let's get into it. So first of all, what is the deposit rate and what does it mean? It's the first interest rate paid by the ECB to banks having a deposit or parking the excess reserves at the central bank. Now, as said, they can place excess reserves at the central bank and earn interest. It's usually 100 basis points or a % below the main refinancing rate, which establishes a floor on the interest rate itself. Since, of course, no bank would lend the money out unless they can earn something at the deposit facility. Of course, that's different. That's not the norm at the moment. There isn't that much of a gap between. There's only a 50 basis point gap between the ECB rate and the deposit rate at the moment. But if we carry on then, so where is the economy at the moment? What is the central bank looking at? Good morning to you, Hader, as well. Good morning to you too. So where is the economy at the moment? What is the ECB looking at themselves in regards to economic indicators? First, inflation at 5.5% compared to 6.1%. Core CPI at 5.4 compared to 5.6, and the S&P manufacturing at 42.7 compared to 43.3. S&P services at 51.1 compared to 52. Consumer confidence at minus 15.1 compared to minus 16.1. Economic sentiment at 99.7 compared to 99.9. And German IFO business climate data that we had this week was at 87.3 compared to 88.5. And the zoo economic sentiment data of minus 14.7 compared to the prior of minus 8.5. German inflation as well, also a very key component of what the ECB looks at when taking into consideration inflation, and how strong it is and how strong it might be for the rest of the Eurozone. So CPI year on year in Germany was at 6.4 compared to the prior of 6.1, and HICP was also higher than the prior at 6.8% compared to 6.3%. So what kind of picture does this paint overall? So in the Eurozone as a whole, inflation is continuing to go down, but in the largest part or the largest component of the Eurozone economy, that being Germany, there is still strong inflation pressures that would still mandate potential further rate hikes, maybe beyond this one. That could be expected from the ECB. Of another 25 basis point hike taken on all three of their rates. So the previous ECB meeting data that we had on 15th of June, so they said inflation projections. So in regards to inflation projections, we'll kind of go through that here. So in regards to the inflation projections, what they've said is that they said that inflation has been high, but it has been gradually decreasing. However, it is projected to remain above the 2% target for an extended period. According to the projections as well, headline inflation is expected to be around 5.4% in 2023, and 3% in 2024, and 2.2% in 2025. Inflation excluding energy and food is projected to be 5.1% in 2023, 3% in 2024, and 2.3% in 2025. Then looking at the economic projections, then they say that the economic projections for growth have been slightly lowered, with the expectation of a 0.9% growth in this year, 1.5% in 2024, and 1.6% in 2025. Then the impact of the rate hikes that we've seen so far from the ECB. They said that the previous rate increases are influencing financing conditions and affecting the economy. Borrowing costs have risen sharply and loan growth is slowing, which is expected to help lower inflation by reducing demand. So if we go into the next point then, So on the next point then, from the ECB meeting minutes that we had for the data. So what do they say here? So first of all, they said that the level of peak deposit facility interest rate, as well as its duration, as embodied in the forward curve and reflected in the staff projections, could be judged as insufficient to bring inflation back to the 2% medium target. Then carrying on, they also said that inflation was still expected to remain too high for too long, calling into question whether it was returning to target in a timely manner. And then carrying on, they said the view was held that a governing council could consider increasing interest rates beyond July if necessary. So following on then from ECB members and what they had said themselves as well. So you had ECB's Lane that said another hike in July seems appropriate, and then they'll see in September. ECB Schnabel said domestic inflation is driven by profits and wages. Nagel said that he expects a 25 basis point hike in July. Nott said that they will need to hike in July as well. And Stornras, who is one of the dovish members from the ECB, has said that another 25 basis point hike would be enough. Inflation is falling, more
tightening could hurt the economy. So that's an interview with CGTN Europe. So we'll go through where the different members lie in the hawk and dove scale. But overall, there is still that requirement for hiking interest rates by the ECB overall from members. But the doves are starting to gain a little bit more momentum in significance of their opinions, as they're starting to creep in, thinking that the overall rate hiking path is more or less enough, but they're still willing to hike by an additional amount. So it depends on how much of an influence do the doves have on the ECB, and what does the statement look like? Do we get a mix of hawkish and dovish comments in regards to where they expect the rate path to be? Or do we get a straight hawkish sentiment or hawkish statement that's provided by the ECB, saying that there may be a need to continue raising rates into the future? Although they won't say by how much, but of course it'd be expected to be 25 unless they do something different. And then for how long is also going to be the other key factor when we're looking into the ECB and what they're going to be doing for the future. So this is the previous hawk and dove scale that we see. So you see the majority of the ECB members, particularly the more important, or the ones have more of an influence on the ECB, are stuck on the hawkish side. So they have the likes of Schnabel and Nagel as well, de Guindos, that are on the more hawkish side compared to the neutral side. But you can see here that you still have those members, particularly Stornras being one of the most dovish members of the central bank, stuck on the dovish side there. So if we compare it to, again, as I said, that was a previous sentiment of where ECB governing council members were on the scale of hawks and doves. Then if we look at the current one, if we kind of go back a bit more, you can see that there's a bit more of a shift to the hawkish side for overall. So you can see that Schnabel, Nagel, and Wunsch and Holzmann have gone more to the hawkish side. Villeroy being the other one to kind of join the dovish side of the central bank, or the central bank members on the scale, going from neutral. And Villeroy has been quite neutral for quite a while. So of course the central bank, the governor for the Bank of France, could have an influence on what the other ECB members think. And of course we will only get a full detail and an explanation of what the ECB members had thought in the meeting minutes, rather than the statement here. But you can see that overall it shows you that there is a mixed viewpoint of whether or not to be hawkish or dovish, but still hawks taking control of the ECB at the moment. Then if we look at the ING crib sheet, it's a very useful piece that they always provide out of what they expect the ECB to say
and where they expect the euro to be, or the euro dollar, how they expect the euro dollar to react. Also with the 10-year bond as well. So their base case scenario is that they see, from what they see, is that there is, they expect the inflation outlook to be unchanged and stay high, but 2025 outlook, they see it at 2%. Is somebody having, who said the screen was black? Oh no. Oof. You should be able to see that. Okay. Let me go back. Apologies for that. Let me sort that out. So you should be able to see. Apologies if you weren't able to see that image there. Let me go back to the other image that I was showing you guys. So hawks and doves and the scale. So so here you can see, as I was saying, that this is the previous hawks and doves scale. Now this is what the current sentiment looks like. So you can see that there has been a shift from, or slight shift from, going from hawkish to even more hawkish, with Schnabel and Nagel, Wunsch and Holtzman moving, or let's say Holtzman stays the same, but Wunsch and Schnabel and Nagel moving towards a more hawkish side with the ECB. And as mentioned, you had Bank of France's Governor Villeroy, who's gone to more of the dovish side. So again, as said, if you weren't able to see it, apologies for that. It's showing it still shows a mixed sentiment from the ECB members, and where they expect, or what the kind of, how much tightening, let's say, in visually would they expect for the ECB in the future. So if I kind of let's go back to the current slide then. So here, the ING crib sheet, again, very useful gives you a scenario, or it gives you the different outlooks, so different scenarios that the ECB could present to the market. So you can see that in ING's base case scenario, they expect inflation to remain, the outlook to remain unchanged, but to stay high, but in 2025 to see it at 2%. Expecting a 25 basis point hike, leaving the door open to another 25 basis point hike. So it's not. So again, the market expectations are very key to understand and have in the back of your mind. Of course, if the market expectation is for, let's say, this to be the final rate hike, and they're not expecting another rate hike to come along, but then in the statement that there is the door left open for another rate hike in September, then what that causes is more volatility, and that's a surprise. With a bigger surprise that's presented, the more volatility that you're left with within the markets, and that means you get stronger moves within the markets, because of course there's a bit more of a panicking going on. So of course, what the current stance is with APP, somebody asked about that, QT, is APP and reinvestment ended in July, PEP reinvestment to end at least until 2020, or PEP to be reinvested until the end of 2024. So you have had some members have talked about maybe looking at the balance sheet to maybe reduce the balance sheet, rather than going with more rate hikes instead in the future. More from the dove side that has been mentioned, not really from the hawk side. The hawks are still in the situation, or in the position of saying we need to hike or continue hiking until they feel that inflation is coming down to the level that they want to see it at. Of course, remember the goal is a 2% for inflation. It used to be at or around 2% with the ECB. Now they're laser focused, they've been laser focused for quite a while, since their rate hiking path of getting inflation to 2%. But besides the quantitative tightening stuff, so let's look at some of the other more moderate or hawkish or dovish sides of the scenario. So on the dovish side, what they expect is, if they expect a 25 basis point hike, but a dovish tilt in the governing council's signaling that the peak has been reached. Similar to the Federal Reserve, what they did, so more or less what the Federal Reserve did yesterday, is they didn't really signal an end to the hiking path, but Powell did kind of say that that's still working on whether or not to continue hiking or not. So not a clear, again, but the markets did rally off of that. For the S&P 500, the dollar did see a decline after that comment was made in the press conference by Fed's Powell. More or less the market's taking it as the Fed has finished with their tightening cycle. But again, we have seen in the past where, of course, when they did pause their rate prior to the meeting that we had yesterday, then they decided that they still left the door open to further rate hikes. So a dovish signal from the ECB would be that they take this as more or less their last rate hike, if they were going to be dovish about where they expect the tightening cycle to end. Other parts as well, if they expect inflation to return to target of 2% earlier than they would have previously thought, and evidence of the Eurozone economy that there is a bit of a deterioration within the economy. So again, not only is it key to look at the figures that come through for the ECB rate itself, but there's also the rate statement that comes with it that we need to be aware of. So you could see maybe, and I've said this yesterday as well, with the Federal Reserve, they could get a hike, but the statement could be dovish, or it could be, let's say, if the statement doesn't really boost confidence within for the currency. What I mean is that the statement is dovish. It's more of a dovish hike. So the hike rates, but they provide an outlook or an expectation of the economy maybe doing slightly worse than they would have expected, or maybe inflation is going to get to their target without them having to do anything else. Those sort of comments are going to be important to be aware of with the rate statement that comes through here. Then we look at the very hawkish side of what ING expects from the ECB, or could expect from the ECB. A 50 base point hike, if that was taken at this meeting on both or on all three of the rates, of course we're focusing on the main refinancing rate and the deposit rate. Those are the ones that garnered the most attention and then the main refinancing rate is the main one. If they decide to go with a 50 base point hike, of course, just the figure alone means that something's gone wrong with the ECB's projections that they've presented to the market, and also what they've seen within the economy. Again, if we're talking about the growth outlook, what could support that? A 50 base point hike, if it were to be taken, that the balance of risks are tilted to the upside, i.e. the economy is performing better than they would have expected it to do. And then the key point, or the key factor, would be inflation, is that they're expecting a new rebound in inflation, and the medium term they see it above 2%, where the inflation goal is. So a stronger than expected economy. Inflation is seeing a rebound that they need to bring down, and also PEP reinvestments is again with quantitative tightening, that PEP reinvestments may have to stop earlier, and discussions on outright sales as well. So actually actively selling what they have on the books, and working on bringing down the balance sheet much sooner rather than later. But again, as said, ING's crib sheet is very useful to have a look at that. So let's go forward. Let's look at some of the bets and expectations. So BNP Paribas now sees ECB hiking in September as well. Money markets on July 12th, they said that they trimmed bets for ECB rates after the US inflation data. Of course, that was when the inflation data was weaker than expected. The sentiment is that if inflation in the US is coming down, then there is expectation that other areas of the global economy, that inflation will come down as well, and the central bank won't have to do that much tightening. Do you remember how I talked about the influence of the Federal Reserve and what they do, how it affects other central banks? Well, that's what's happened here. It's the expectation that if the Federal Reserve is starting to take their foot off the brake, then other central banks will more than likely follow through with a similar trajectory themselves.
So the December 2023 ECB ESTR forwards also fell to around 3.89% from 3.92 before the inflation data, and that implied an ECB deposit rate of under 4% by the year end. Then July 17th, Moody said the Fed and the ECB are poised to raise rates in July, despite calling inflation. And July 25th, Goldman Sachs also cut their 2023 euro area real GDP growth forecast to spot 4% as well. So now we're going to look at the previous market reaction from the ECB. Okay, of course, the 25 basis point hike decision was taken for both the rates that we're looking at. But what we're looking at for is of course, the initial market reaction and what the sentiment was that was provided around it. And what you realize is the market reaction wasn't really that great. And if we look at the deviations sheet, which I'll bring up for you here after but you can see here in the markets, there wasn't that much that happened. One, because the rate was as expected, and the statement that was paired with it didn't provide any surprises. It was more or less the same of what had been said before. So the surprises that you would be looking at would be whether or not the ECB in this meeting say they expect inflation to fall much sooner than expected. For the dovish side, if they do decide to just maintain taking a 25 basis point hike at this meeting, and on the flip side, if they expect inflation to be much stronger than they would have expected it to be, and if they see a rebound in inflation in the Eurozone. And of course, pairing that with a better than expected outlook for the Eurozone economy, or stronger than expected outlook for the Eurozone economy for the hawkish side, and then vice versa for the dovish side as well. So if we kind of skip through a little bit more of the video or the previous market reaction, as said, it wasn't the initial market reaction wasn't that huge or great as we had seen in the past rate decisions, where there's been a surprise provided to the markets with the rate decision itself. So if I go through let's go through the deviation sheet then. Okay, so the deviations here, so let's have a look at it here. So you can see that it wasn't really, there we go, yeah, the ECB rate decision. So the market reaction wasn't that great, wasn't that big. Again, the figures came in as expected, and the statement paired with it wasn't that big, wasn't that surprising either. It was more or less the same. So you can see here, the biggest market mover, though, if we're talking about what to kind of focus on, was on the Euro Japanese yen, or Euro JPY. So that had the biggest market reaction of about 25.5 pips towards the upside. After about 10 minutes of trading, it was up by 36.5 pips. So again, this is showing you the initial market reaction going to the wick, and this figure here in the brackets shows you the market reaction 10 minutes after the release going to the end of the candle. This is all on a 1 minute chart, by the way, just to let you know. So don't forget, if you have found this information useful so far, don't forget to like the video, subscribe to the channel, get the word out there. We've got about 5 minutes left till the rate decision. But yeah, overall, the market reaction, although there was a market reaction, it wasn't as great as what we'd seen here in the past back in March 16th, where there was a bit more movement that had occurred within the markets. Also, another thing to be aware of is that the euro, the New Zealand dollar, and the Aussie dollar had a bit more of a stronger market reaction than the euro Swiss franc and the euro dollar. So that's also these two are another two pairs to be aware of market reactions and how strong it could be. So let's move that to the side. We also, as said, are going to be covering the GDP data as well from the US. But let's get ourselves set up on our charts here for the Euro data release. So, of course, FinancialJuice, the service that we providing live real-time voice and text service for you guys, particularly if you're a day trader. We keep you up to date with moves that are happening with the markets and why they're moving.
and also the global macro news of what's affecting the markets as well. So let's say Fed's Powell, like he did yesterday, says something about the expectation where they see the rate in the future. That's also something to be aware of as well, and that we provide information of for you guys. So again, FinancialJuice is a live real-time voice and text service, and what you can do is we do have a 7-day free trial of FinancialJuice, but for those of you who want to just have a little play with it and get an understanding of it, you can sign up to the light version of FinancialJuice. Again, still quite useful but the pro version doesn't have any adverts playing. There is no delay to the voice or text feed that you can see here. So the voice feed here, where there's a little button, and then you have the news feed with the text that comes through as well with the headlines. And on the left hand side here, you've got your economic calendar as well for the economic releases. So again, with the pro version, there are no delays. There are no adverts that are played as well. Everything is in real time. So if you're, as I said, particularly if you're a day trader, you want to keep an eye out for what's going to, if there is a movement in the markets and there is a bit of news paired with it, then you want to know that as soon as possible. Doesn't mean that the light version isn't useful or useless at all. Of course, there are some benefits to it. If you're not ready to kind of sign up to the pro version, you can have a play with it, have an understanding of what the product is all about. If it's the first time that you've kind of seen and had a little play with it. Okay, let's have a little look here. All right, so let me get my TICKSTRIKE set up and ready for the release. We've got about a minute left to get the data. Okay. Today we actually have Ben on the microphone doing the economic release. Okay, 1 minute to go. Let's get our European releases set up and ready. Okay, let's switch that around. Okay, so we're looking at the 10-year bond in the bottom left, the euro dollar here. Actually, let's bring up the euro JPY, because that had the biggest market reaction the last time round. Okay, right. It's all set. Let's see what this does. Remember, 10 seconds. So we're looking for the rate and the statement to see which direction we're headed into. Okay. Hike 25 basis point hike, 25 basis point hike as expected. Deposit rate hike, 25 basis point hike, 25 basis point hike as expected as well. All right, what else do we have? Let's see what's going on. Okay, so let's see what the ECB said. So you see that weakening there from the euro, initial weakening there. Not seeing too much of a reaction on the DAX. 10-year bonds though, seeing a bit more of a reaction. Let's see what they said. So ECB rates will be set at sufficiently restricted level for as long as necessary to achieve a timely return to the 2% inflation target. So again, nothing really surprising there. They'll continue to follow a data-dependent approach. Let's see what else have they got here. Inflation still expected. So inflation still expected to remain too high for too long. Again, that was something that was within the expectation from what ING had looked at. Just trying to see what else, if there's any kind of surprises here, but there are no surprises here though that we can see so far. They say developments since the last meeting supports the expectation inflation will drop further. Okay, so the expectation that inflation is going to continue to decline, and that although it does remain too high, they do expect it to continue to make its way down. So that's what's the main reason for the euro seeing a weakness.
within the markets at the moment. So expecting inflation to continue to go down, and more or less they're doing their job. Again, no other any other weird surprises or anything that's out of the blue from the ECB. ECB says that past rate increases continue to be transmitted forcefully. So that's again one of the other dovish comments again that is affecting the economy. Although they're not saying, they say future decisions to ensure rates are sufficiently restrictive. Financing conditions increasingly dampening demand. Yeah, that's basically it. Okay, so we've got the DAX. That's moving. So it did move slightly higher off the back of that data there. The bunds. When we look at the bond price here, for 10-year bonds, did see that wick towards the upside. We'll quickly have a little look at let's get the market reaction on the Euro JPY. So it was about 25 pip move down. Of course, we do have the GDP data to cover as well for the US. So I'll quickly do some base measurements here on the different assets, and then I'll head over to US GDP data. It's about 7 ticks up, so that's nothing. Let's see, what else do we have? Okay, so there's about 30 ticks towards the upside on the 10-year bonds, and the euro had seen again a weakness there. So a cleaner move compared to what we had seen last time round. The key point being there in regards to inflation, let me just bring it up again. Inflation continues to decline, but is still expected to remain too high for too long. Let's bring it back up again. Where'd it go? Yeah, there we go. Developments since the last meeting support the expectation inflation will drop further. Okay. All right. So let's head on over to the other data points now. Let's go over to US GDP data. I'll just bring that up for you. Okay. And close TICKSTRIKE for now. And let's bring that up here. There we go. Okay. All right. So yeah, hopefully you guys were able to find that information useful for the ECB data. Now we've got 10 minutes, so I'll have to quickly go through this here on GDP data. So GDP, what does it represent? The total dollar amount of all final goods and services, even if it's on the shelf in storage and hasn't been sold, and that's presented in the annualized rate. So it's the best measure that the US government has, and also the Fed as well, to view how quickly or slowly is the US economy expected to perform over the year. Okay, so it's at an annualized rate. Then core PC prices is also going to be quite very key as well. The PC prices for the quarter measures the change in price for goods and services bought not only by consumers but also the government, and represents spending and private inventory investment, excluding food and energy. But the key difference between the GDP price index and the PC price index is that the GDP price index looks at the economy overall, including everything produced, whilst the PC price index looks specifically at things that consumers are purchasing. Both are useful for understanding inflation, but they have slightly different purposes. So just again, with core PC prices, there's more of a weight on what consumers are paying for goods and services, rather than
rather than the government and everyone else, well, the government and businesses as well. Let's carry on. So the fundamental effects. We're going to have a quick look at the previous market reaction for the final data for GDP. But better than expected data shows, or GDP shows, that the real standards of living for Americans are improving or are better than expected if you get a higher reading for GDP data. So I'm going to have to kind of go through this here. So stocks usually have a positive reaction if GDP is higher than expected. It shows that businesses are doing well. Also that there is a productivity is also increasing too, so that's also positive for the stock market. For the currencies, same thing again. Stronger than expected data can firm up interest rates as well, but again, if the economy is doing well overall, there's confidence that's injected into the currency itself. For the bonds, simple. If the economy is doing very well, bond traders will likely sell their bonds. So what would happen is the bond price will go lower and the bond yields will go higher because the government is then more confident in them providing their debt at a higher rate of interest for a lower price as well. So bond prices usually take a hit if the economy is doing well and bond yields continue to rise. All right, so where is the economy at the moment? So the first quarter, well, of course, we're looking at the second quarter data today. So the first quarter ended up at 2% compared to the fourth quarter of 2.6%. Inflation at 3% compared to 4%. Manufacturing data was weaker than expected. Industrial production was also weaker than expected as well. Durable goods orders, again, another key measure of the strength of consumption from consumers, and also how a business is performing too. If there are an increase in orders, that means there is an increase in demand for those goods that are created. Non-farm payrolls at 209k compared to 339k. Michigan sentiment was also stronger as well. Consumer spending was weaker, but retail sales, but not that. There wasn't that much of a significant difference or significant decline in consumer spending or consumer spending patterns. Forecast range then for the high and lows for what we're looking for GDP. Of course, the median expectation what we have GDP is 1.8%. The high estimate or economists are presenting is 3% with the low of 0.8%. The core PC prices, okay, that's also going to be a very important factor too. If core inflation is stronger than expected, that might mitigate how much of a positive reaction that the S&P has. So the S&P the stock market has got to deal with two different things. Is GDP strong? And second of all, is inflation strong as well? So again, just going through that. So the highest expectation is 4.2% with a low of 3.9% for core PC prices. Powell said the staff no longer forecast a recession. There's a lot of uncertainty about the outlook to the next meeting, let alone next year. CBO, they expect GDP to rise to 4% at an annual rate in the second half of the year. Unemployment rate is seen as 4.8% at the end of the year compared to 5.1% seen in the February expectations. IMF's chief economist Grinch has said the US has a narrow path to avoid a recession. All right, investment bank views then. So you had NAB, which say that the service sector and labor markets has allowed the economy to continue expanding. So they're expecting the economy to continue to pick up some steam. Deutsche Bank sees GDP at 2.3, Bank of America 1.5, Goldman Sachs 2.5, as does JP Morgan, and BMO sees 1.7%. So this was the final data that I do want to get in to show you guys what kind of reaction we could expect. So the final data, okay, so the second quarter of GDP quarter-on-quarter final was at 2% compared to the estimate of 1.4%. So you had a positive reaction from all from the markets. So you had bond yields that went up, and of course bond prices go down. The S&P had also gone up, and also the DXY as well. But you can see here on the S&P in the middle, that there was a wick down. The reason for that wick down was because inflation was stronger than expected, the PC prices. So what do we need to be careful of today? If you get stronger than expected GDP data, and you also get stronger than expected PCE data for the core data, that will likely mitigate how strong of a move you get in the stock market. Okay. Of course, there is the expectation that inflation is still quite key to forward guidance, say, for the markets itself, and what they expect the Federal Reserve to do. So if inflation is still strong for this quarter report that we have, then there may still be expectations that creep in that another 25 basis point hike might be taken from the Federal Reserve, and that means that the markets will start to speculate and start to price in for that scenario. But if you get data, let's say data overall is bad from the GDP data and inflation is down, then you would expect a negative reaction or the inverse reaction, what we see here. And you wouldn't really see the S&P have a bit of a wick if the inflation data is also weaker than expected. But of course, it doesn't bode. What that could mean is that the central bank might have to flip the switch and continue pausing and maybe cut rates earlier than they would have anticipated. I know I'm going through this very quickly. I want to do GDP data for the advanced data, but we've got about a minute and a half left till that report comes out. If I quickly go through the last reaction, what we've seen for the advanced data back in April. Okay, I'll skip through. Okay. So I'm going to kind of go. See what we have here. So the data comes out. Okay. GDP is weaker than expected. Okay. GDP deflator advance is stronger. Okay. And also core PC prices are stronger as well. So you see this negative reaction from the stock market. So the initial reaction here, but was also to bear in mind, is that if GDP data is weaker, that it could mean that the Federal Reserve may have to pivot sooner rather than later. So that's another thing to be aware of with the market reaction here. Hopefully, does that make sense to people? I know I've gone through that very, very quickly here with you guys. But overall, better than expected data with a weaker than expected inflation print would help the stock market and also the dollar as well, and also bond yields. But if you get a mix of data where GDP is better than expected, but inflation is also stronger, then you'd expect a weaker reaction, i.e. a not so strong a reaction from the S&P. We might see a bit of a wick down, maybe, and then move it towards the upside on the S&P. Okay, so data has come out, 2.4%. Oop. Okay, so let's have a look here. So that's 2.4% for the GDP print. Okay, 2.4%. That's higher than the forecast of 1.8. We're looking at the core PC prices at 3.8%, 3.8% lower than the forecast of 4%. Let's get the USD/JPY here as well. Okay, there we go. Dollar yen, seeing movement towards the upside. Let's get gold up here too. All right. Gold seeing a move towards the downside. So there's a bit of a wick. There's a bit of a wick down on the S&P. So again, what we've seen here. So initial jobs claims also weaker. Initial jobs claims were 221k, lower than the forecast of 235k. So not really that much reaction from the S&P. Although GDP data was much stronger than expected, and inflation in the core data of core PC price advance was also weaker than expected by 0.2%. You didn't really see that much of a reaction here on the S&P. It was actually it's just whipsawed compared to the dollar yen. Dollar yen compared to the dollar yen, didn't really have a clear reaction. But the dollar yen, let's have a little quick measurement of that here.
let's see, what did you do? What did you do? Okay, it's about 29.5 pips towards the upside there on the dollar yen. S&P quite mixed. So we'll note two moves here. So we got this move here, 8 ticks down, and then about 8 ticks up. Let's have a look at gold as well to see how gold performed. Wait down there. It's about 77 ticks down there on gold. Okay, so we got bond prices. Okay, so what bonds did. And bond prices also ticked down, so bond yields did head higher. It's about 19 ticks down on the 2-year bond. So more of so as I said, a whipsaw reaction from the S&P. I'm going to bring up the NQ as well. See if it's mirrored as well. Let's see, what did you do? Okay. Alright, so again, a bit of a whipsaw reaction there. But can see is a bit more positive reaction now happening. So what I take it as is that GDP data was positive, but also inflation did come down on the core PC prices, part of the report. Okay. So now it looks to be that it's got a direction. Okay. Okay. All right, so now the stock market is reacting in a positive way. As I said, probably the key point of that being there is that in the inflation print was weaker than expected. Okay. All right, so the NQ going up, S&P going up now alongside the dollar. That basically concludes the stream for MacroAce for the week. And of course next week we'll be getting Apple earnings. Overall, yeah, no, I know it's the futures. It's just representing the market reaction overall, the strength of the market reaction overall. So you'd probably see a positive reaction from everybody else. Right. Okay, so there we go. So yeah, the stock index is there. Did see that bit of a positive reaction off that data. Alrighty. Thank you very much for joining me live. Don't forget to like the video, subscribe to the channel, get the word out there. If you found the information useful, if you haven't, let me know in the comments, or you can also alternatively email me as well with your reviews. Your reviews and comments do help in providing a better service for FinancialJuice and also MacroAce as well. So there we go. That is a summary of it all there. Thank you very much for joining me, and I will see you guys next time. All right. Oh, also don't forget, if you wanted, so somebody did have a question about the deviations for the economic releases. Okay, so if you sign up to the MacroAce mailing list here, not only do you get the deviations or access to the deviations sheet for the not only for the upcoming economic releases, but the other economic releases that we've provided in the past, you can get that for free. You can sign up to the main list, get that for free, but you'd also get an update on what to expect for the week ahead for Asia, Europe, and the US, i.e. what is the sentiment, what is the news surrounding those different sessions, and then also and also you get the links for the live streams, for the upcoming live streams as well. So one of the things to be aware of is that if you do sign up to the MacroAce mailing list, it is quite short and concise. There isn't a lot of detail that's provided in there. It's one email every week on a Monday that's provided. And because, of course, most of the detail that I provide to you guys is here in the live streams with you guys here. All right. So thank you very much for joining me live. I will see you guys next week. All right. Bye.